Hi, this is Scott McLeod with Brown Financial Advisory. I just wanted to spend a few minutes with you today. The market has sold off over the last few weeks, including the bond market, and the economy has showed some sign of weakness. So I thought I'd spend a few minutes with you in a two-part series this time, talking about what's been happening in the stock and bond markets and also what we expect from the economy. So let's get started. First thing I'll share with you, just a quick disclosure, and then our agenda. So to begin with, we're going to talk about what's happened in the stock and bond markets recently, both in the most recent periods and also over the last few years. The next thing I'd like to talk with you about is what we expect to happen next in the stock and bond markets based on valuations and where we are in the cycle. And then finally, in the second part of the series, we'll talk about the economy, where we are as far as the Fed is concerned, the outlook for the economy going forward, and some of the timing issues. So first of all, we'll talk about the current performance in the stock market. As you can see, we have some negatives in the stock market right now. The first line item is the Consumer Price Index, which is up 345 year over year. As you know, the Fed target is 2%. So the Fed feels like it has quite a lot of extra work to do from here. And we'll probably see the Fed continue to be a little bit more aggressive as the inflation rates come down. Now, good news is we've seen inflation rates kind of trend year over year down, but also the month over month rates are trending down, with month over month rates averaging somewhere in the 3% range. So we're closing in on that 2% target, but we have a little bit more work to do before they're finished. Now, the most recent sell-off is in reaction to what the Fed has said about those targets. And the most recent announcement was that the Fed was going to remain where they are now, not even considering lowering rates, but also leaving the door open to raise rates in the future. Well, that spooked the market a little bit, and we saw a sell-off that began a few weeks ago and has continued until just this last Friday. And the sell-off was both in stocks and bonds. So we saw both sides of the portfolio contracting over the last few weeks. So you can see now the index for the U.S. Investment grade taxable is actually down 2%. So this is the Barclays Aggregate Bond Index, and it's down 2% for the year. Tax-free is down 1.29 for the year. And then other bond markets are actually up, including Strategic Income, which is also in our portfolio. On the equity side, you'll see the stock market in the U.S. is actually up 12.44% for the year, which is leading all the other equity indices around the world. U.S. small company stocks are down 0.67, international stocks are up almost 3.5, and emerging market stocks are down about 1. The worst equity asset class in the portfolio right now is real estate, which is down 4.24 after being down significantly last year. Now, the big story behind the performance that's happened in the most recent few years is actually not stocks. We expect stocks to have a level of volatility throughout the markets, as you know, but the bond market has actually been the big story. And here's why. When you look at the bond market over the last few years, you can see that there's been a terrible rout, if you will, in the bond market that started in early 2022. This chart shows the Vanguard Total Bond Market Index ETF, which is a very low-cost proxy for the Barclays Aggregate Bond Index, and therefore it's a very close performance metric, if you will, for that index. And you can see in the middle part of the graph here, the graph is actually showing an increase in the bond market from about 2019 through 2021. So the increase ran up in 2019, 2020, and then it started to come back down in 2021 and 2022, particularly. This year, it started to climb in the early part of the year, but it came back down again. So when you look at the 19, 20, 21, 22, and year to date, almost a full 5-year period, the return on this particular index is terrible. In fact, it's one of the worst years in history, where we've seen a 5-year annual performance number of 0.10%. This is an annualized return for the U.S. bond market of 0.10%. So when you're thinking about a diversified portfolio and you consider that the bonds are a significant part of that, well, you can imagine that that bond index return matters quite a bit. And historically, it's generated a healthy return to provide some balance to the portfolio. Over the last few years, it's failed to do that. In fact, it's somewhat rare that the bond market goes down during periods of stock market declines. And in this case, not only did it go down, it went down more than many times in history. In fact, often people say to me when they talk about the stock market, well, this time it's different. And I usually respond by saying something like, it's different every time, and that's what makes it the same. And that's true in a lot of cases. But in this case of the U.S. Bond market, it is actually different, significantly different. In fact, when you look back through history, there hasn't been one single time in the last 100 years that the bond market has declined at this magnitude and for 3 consecutive years. So this is a very serious divergence, if you will, in normal bond market performance. And it has impacted every portfolio performance that has bonds in it for that simple reason. So why do we have bonds in the portfolio in the first place? Because typically bonds are a safe haven for the volatility of the stock market. So at any given moment, the stock market can decline 10% or 20% or even worse, as you know through history. But bonds don't typically do that, especially the Barclays Aggregate Bond Index, which is primarily U.S. Treasuries. It's a very stable return over time. Unfortunately, whenever interest rates rise rapidly, as we'll see in a moment, that causes bond prices to decline. And so we saw a significant decline in prices during a period when stocks were also declining. And that was an unfortunate combination of events. What that means then is that even an index-based allocation has been damaged by this most recent performance, and the longer-term performance numbers are down a bit. So this is the Vanguard Life Strategy Moderate Growth Index, which is essentially an index of an allocation fund. So it's a fund of index funds that represents a 60-40 allocation. So you know, as research says, index funds typically outperform actively managed funds over time. So we like to benchmark against an index fund, but we also like to benchmark against an allocation fund of index funds to give us a good idea what's happening in the markets and if we're outperforming. So this is a great example. And you can see in 2020 and 2021, even back to 2019, this fund had great performance numbers. 2019, it was up 19%. 2020 was up 13%. 21, it was up 10%. And then in 2022, it was down 16% and only up 5% year to date. Most of the 16% was attributable to the bond portion of it. Stocks were down in the U.S. about 18%. International stocks were down about 14%, but the U.S. bond market was down 13%. So you add that in with U.S. stocks and you see terrible one-year performance down 16%. That's not unprecedented, but it's not normal. I can just tell you that. And what that does, especially when you hit that type of decline at the back end of a period, is it causes the average annual return to come down significantly. And you can see down here on the bottom of the page where you see the 3-year and 5-year performance figures. Those numbers represent the annualized return over the last 3 years and over the last 5 years. And the 3-year annualized performance for this Vanguard 60-40 allocation is only 2.34%, and the 5-year performance is only 4.15%. So what that should tell you is that generally the performance looks depressed right now because we are still in the process of recovering from the declines that we saw last year, both in the bond market and in the stock market, and that recovery hasn't taken place yet. So as a result, we're still in the trough, and the combination of bonds and stocks being down so significantly last year has hurt the annualized performance. But you shouldn't be discouraged by that because it's just a recent measure while we're still in the trough. So these small numbers that you're seeing in terms of performance, and it even impacts longer term performance than this. You would think that it wouldn't, but when your portfolio is at its largest, you're carving off the highest percentage of that, down 16% on this particular index, and that has a negative impact on your long-term performance. So the first thing that I would like to emphasize in terms of the most recent stock and bond performance is the key takeaway, which is we've only seen a partial bounce in the stock market, and we've not seen a bounce at all yet in the bond market. So what I mean by that is that the partial bounce in the stock market has not recovered fully what happened in 2022. 2022, U.S. stocks were down 18%. International stocks were down 14%. So we've seen a little bit of a bounce, about 12% in the U.S. and only about 3.5% in international. It extends across the equity markets where we saw declines last year And we've not seen a full recovery of those stock market declines this year. We've captured a lot of it. In fact, nearly 20% bounce as we've seen from the bottom of October of last year. However, unfortunately, we've not seen all of the bounce yet, and therefore the markets, the portfolios are still down a little bit from where they were at the beginning of 2021. The other takeaway is that we have not seen any bounce in the bond portfolio. So if you have a 50-50 allocation or a 60-40 allocation with 40% bonds, then what you're going to see is that the bond portfolio has not bounced at all. So bonds are essentially flat. Now, our portfolio is more broadly diversified and we've outperformed the index, but still the better part of that bounce is still yet to occur. So that's what's coming next in the presentation. What happens next with stocks and bonds? And this is a particularly important thing to remember, because I'm going to share with you something that is unique and that you may not be aware of happening in the US stock market and the US bond market. First of all, most people aren't aware that although the US stock market is outperforming other global markets significantly right now, there is a fundamental problem with that performance. And it is that it is concentrated in very few stocks. So what this graph describes for you is the top 10 stocks of the S&P 500 and how they have outperformed over time. And unfortunately, year to date, carried nearly the entire U.S. outperformance. Even the 12% that we've seen so far this year has been generated almost exclusively by just a few stocks. As you can see from this graph, the top 10 stocks have shown 150% performance, a little bit down from that now, maybe call it 145% performance year to date. Whereas the blue line at the bottom, that's the remaining 490 companies represented in the S&P 500, and you can see they're maybe barely 4%. So what's happened is that 12% return, in large part, has been generated by just 10 companies, and the valuations of those companies have extended well beyond comfortable. In fact, they're way beyond what is normal for that particular part of the market, and it makes the performance very fragile. I was hoping to release a video some time ago because we could see this happening from weeks back. This actually dates back to August 14th, but we could see it from weeks back how these few stocks were driving the performance, and they rose so rapidly that they pulled the S&P 500 up with them. But unfortunately, as you can see from these charts, the top 10 stock valuations are now really, really high. So they represent about 128% of the long-term average for valuations of the top 10 stocks in the S&P 500. In fact, if you date it back, it's about 27 years. You might remember the dot-com bubble. We haven't really seen this disparity in valuations in the top 10 stocks versus the rest of the stocks in the index since that bubble burst, and that was back in 2000. And unfortunately, what happened to those stocks after the bubble burst is they fell precipitously and for three straight years until the valuations were more in line with the rest of the market. And then it tracked with the rest of the market until just recently, when they exploded up through about 34 times earnings. And then they've come down since then a little bit, spiked back up to 29 times earnings, and now they've come back down a little bit, but still well above where the market is overall. You can see the difference in the performance here with regards to the valuations and so forth. The other thing that's a little bit disconcerting is how much those 10 stocks now account for the value of the S&P 500. So through September 30th, you can see on the top right corner here, the valuations of those stocks have increased so much that now they account for almost 32% of the overall market capitalization of the S&P 500. So basically what you're saying is that the value of those 10 stocks is 32% of the index, and the other 490 companies represented are the other 68%. So it's amazing how much they've grown, and the valuations have driven that market capitalization up. The problem is the graph below it, where you see the September 30th contribution of earnings. So while they're 32% of the index, they're actually only contributing 22% of the earnings. So that should tell you that those valuations at 128% of the average are really out of sorts. And that creates volatility in that part of the index. And you should be aware that that volatility is likely to come to fruition. And what that means is they're likely to pull back to reasonable. So the other valuations are actually well within tolerance. If you see the 25-year valuation average, it's only about 106% or so of the long-term average. So it's well within reason on all the other stocks. It's the top 10 stocks that are causing the index to be overvalued, which means when those stocks come back to reasonable valuations, we're going to see the U.S. stock market likely decline a little bit further, or earnings have to pick up on the other companies in order for it to balance out. Now, the next thing I want to talk with you is about bonds, and this is how bonds typically work. So a lot of people aren't familiar what a bond is. It's basically a debt instrument for companies and governments, and they issue debt and they issue a bond. It's a little bit like a CD, but I like to liken marketable bonds, things that we have in our portfolio in bond funds, a lot like a rental house. So how does a rental house work? Well, you buy a house, say, for example, and that house is worth $100,000, and you set the rent at $5,000 per year. Well, that means that $5,000 on $100,000 gives you a 5% return on the house. So if everything goes as planned and the values all remain the same, you'll get 5% per year forever. However, what we find in the real estate market is often when interest rates rise, the values of homes tend to come down because you have fewer buyers at that level, and the prices have to come down to kind of accommodate. So you see this inverse relationship between interest rates and housing prices. And so the interest rates go up and you watch the prices of homes come down. So say, for illustration, that we see the value of our home come down to $90,000 from $100,000. So the question is, if you were getting $5,000 rent on that house, when it drops to $90,000, how much rent are you getting? You're getting $5,000. It's the same amount of rent that you would have gotten before because the rent hasn't changed. So that's the way housing markets work. The $90,000 drops, or the $100,000 drops to $90,000, but you're still getting your rent of $5,000 per year. That's one of the things that makes rental properties and rental real estate really nice, because you still get your rent. But if you do the calculation at the end of the year, what is your annual return? The annual return is negative 5% because you've lost 10,000, but you've only made 5,000 back. So negative 5% is your annualized return. Now, the thing to know is that bonds work exactly the same way. When interest rates rise, you see impacts on bonds. But if we take the same illustration and say we have a $100,000 bond that has a 5% yield, what's a 5% yield on a $100,000 bond? It is $5,000. It's a 5% return on the money, $5,000 per year. You'll hear people talk about a coupon. If you have a whole diversified portfolio of 1,000 bonds and they average a 5% yield, then it's a $5,000 per year income. That's not going to change. That remains the same as long as the bond has not defaulted. It will remain the same. But the same dynamic with interest rates applies to bonds as it does to housing markets or to rental real estate. So as the interest rates rise, you see a decline in bond prices. And you say, well, why would that be? Well, the interest rate is influencing the bond price. So if you have a 5% bond, for example, and interest rates go to 6%, if you try to sell that 5% bond, well, you're not going to be able to sell it to someone if they can go get a new 6% bond. So you have to discount the price. That's what's basically happening in the bond market. So last year was the worst case scenario. We started with relatively low bond yields, and the interest rates rose rapidly. So in this illustration, the interest rates rose by 0.25%, and the bond price dropped by $20. That assumes that there's about an 8-year maturity on this bond, and that's not too far away from what the index was last year. But instead of a 0.25 point rise in interest rates, we saw almost a 5% increase in interest rates over the last couple of years. And so it's really pushed bond prices down a lot. However, in this illustration, if we take the same thing that we talked about before, and let's say that that bond dropped to $90,000, how much income do you get? You still get $5,000. It's just like the rental house in that regard, but there is one difference in the rental house and the bond illustration. The rental house never matures. So as the bonds mature, as they get closer to their maturity dates, and they all have maturity dates, they all mature back to the $100,000. Now, your rental house may not. Your rental house may stay at 90 and just be there. It'll just be there at whatever the market price is at the time. But bonds are not that way, which means if the interest rates rise and you hold on to the bond, the face value of your bond may go down a little bit, but it will eventually come right back to $100 a bond. That's what they're typically sold for. So what we see in a diversified portfolio, the same thing applies to bond funds as it does to individual bonds. A bond fund is just a collection of individual bonds, and the bond fund managers know how to manage those bonds so that they hold to maturity if they need to, or they replace them with higher yielding bonds, depending on what's happening in the market at that time. But as those bonds mature, they will mature right back to $100. So you get your $100,000 back, and you still get the 5% yield all along the way. You still get the $5,000. So on paper, it is showing a negative 5% return. That's just basically how that calculation works, just like your rental house. But also just like your rental house, if you haven't sold the bonds, you haven't sold the house, then you don't have a negative 5%. That's a paper loss. You're still getting your $5,000 per year yield, and that's basically what's happening in the bond portfolio right now. But the great thing about bonds is that the inverse also applies. So when bond yields decline or interest rates decline, you start to see prices in bonds go up significantly. And so what we're seeing right now is the anticipation of the decline in interest rates. In fact, the Fed releases reports about the bond market and the interest rates, and you can see by the dotted line here that we're anticipating interest rates starting to decline early next year. So we thought they might decline this year, but that was a little bit far-fetched. We think now that they will begin declining early next year. And so what will happen is you see the bonds, they come down over this period. And if you look, I'll look at a little bit more closely. You can see that in 2024, we're expecting a decline in bond yields of somewhere on the order of 0.5% or so, maybe almost a full 80 basis points to 100 basis points by the end of the year. So maybe call it a 1% decline in interest rates is kind of the top end of the expectation right now. And you might see almost 2% by the end of 2025. So the anticipation is things are going to slow down. The Fed will begin lowering rates. Both the Fed and the bond market itself are pricing in declines in yields next year. So we would expect to see increases in the portfolio. But what does that mean exactly? So we asked Guggenheim to put together a hypothetical illustration that pretty closely matches their bond portfolio, but is also similar to the index. And this illustration shows exactly what happens. So if you look at the top line here where it's the yield to maturity. So right now, the yield to maturity on the Guggenheim fund is right about 6.8%. So that means that as the bonds mature, you would expect to get almost a 7% return on those bonds. But what's even more significant is if you track out here to the right and you see a 1% decline in interest rates, that fund is expected to be up 13.2% over a 12-month period. So in other words, if we see the 1% decline in interest rates next year that we anticipate, then it's not unreasonable to consider that those bonds would go up 13%. If for some reason the Fed started lowering rates faster, maybe they felt like they overcooked the slowdown, then basically what we would expect to see is a return that's upwards of 20% on that fund. So 13% on a 1% decline bakes in a lot of potential in the bond market. So everything that's happened in the bond portfolio that has pulled back the returns, that's likely to be paid back with the decline in interest rates and those double-digit returns in the bond portfolio. So it's something good to look forward to. The idea is that we haven't seen any of that bounce yet. In fact, the opposite has occurred. So with just a little bit of patience, we'll get to the point where we see the final part of that bounce and the portfolio will grow with what's happening in the bond market. So the very last thing is the key takeaway with regards to the bond market. And that takeaway is the U.S. stock market performance is concentrated in just a few very expensive stocks. And that means that there's some downward pressure on the U.S. stock market that will take a little bit of time to work through. However, U.S. bonds are poised for a significant bounce. So we've seen pretty good returns in the early part of this period, 7-8% in that frame. But we're now looking at returns in the U.S. bond market that are yield to maturity returns of almost 7, meaning just you'll get a yield to maturity from here of 7%. But if the interest rates decline 1%, we're also looking at healthy double-digit returns that will enhance the portfolio performance overall and help with the rest of the portfolio returns. So what I want to share with you next, and in the second part of our sequence, is what's happening in the economy and what we're going to expect to see in our portfolios going forward. Thank you very much for listening.